Good morning to everyone and welcome Mr. Nilesh Shah and all the participants. Hope you and your family members are doing well and safe during these Corona times. Prakla Wealth Management is happy to welcome you all for this webinar with one of the renowned speakers in the country, Mr. Nilesh Shah. With the technology at the forefront of the world economy, we also would like to bring our customers, well-wishers, mutual fund investors at large, and our YouTube subscribers closer to the fund managers with whom they are trusting and putting their faith and investing. Although we have done many fund manager interviews in the past, this is the first time we are conducting a webinar, that too with industry stalwart Mr. Nilesh Shah. Earlier, we did an interview with one of his colleague, Ms. Lakshmi Iyer, on debt mutual funds, and that helped a lot of people to get clarity on debt investing. Many of our investors signed up for the webinar as soon as they received the communication from us. This shows his popularity among the investment community. Mr. Nilesh Shah is the Group President and Managing Director of Kotak Mutual Fund, overseeing assets worth 1.9 lakh crores, just above 1.9 lakh crores. He is a member in our Prime Minister Narendra Modi's Economic Advisory Council. So I hope he has all insights about the country and happenings. And he is also the chairman of AMFI, Association of Mutual Funds in India. I don't think there is any other better person than Mr. Nilesh Shah to speak about current global events and their impact on Indian equity mutual funds. There are a lot of doubts, questions, and in investors' mind at this point of time, such as US elections, whether Biden is going to come or Trump is going to come, what will happen to the economy when someone comes. China issues, India's tension with China, and China's tension with the USA, Europe, and many other countries. COVID issue all over the world we are facing, and quantitative easing, because of which markets have gone up, and many such events happening all over the world which are affecting day to day the stock markets and our stock markets too, and hence your investments in equity mutual funds. I am sure that Mr. Nilesh Shah will clear all your existing doubts and give a great clarity in his next 30-40 minutes address. The format of this webinar is like this. All the participants will be on mute mode. Mr. Nilesh Shah will deliver his address for the next 30 to 40 minutes, post which there will be question and answer. Keep sending all your questions through the chat box. During the question and answer time, Mr. Nilesh will try to answer most of your questions. We expect this session in overall to take about an hour to hour and 15 minutes. With that, I request Mr. Nilesh Shah to address our audience. Thank you very much, Nilesh. Thank you very much for accepting and coming on this Saturday on a webinar for our subscribers, customers, investors, and mutual fund investors, Tamil-speaking mutual fund investors at large, all over the country and world. Thank you very much. Please.
Thank you, Mr. Chokalingam. Good morning to everyone. This is one of the toughest times we have seen in our life. In the past, we have seen financial crisis like 97 Asian crisis, 2008 US subprime crisis, 2013 taper tantrum, or 2016 demonetization days. However, in our lifetime, we have never seen a medical crisis, a financial crisis, and an economic crisis coming together. Normally, when some event occurs, we try to go back to our prior experience and learn from it. And we then navigate future based on past experience anchor. This time, unfortunately, there is no past experience. 100 years ago, there was Spanish flu. It killed millions of people around the world. But in those days, data was not as concrete as it is today. And learnings from those days is not applicable as much in today's world. Hence, everyone is navigating this crisis based on gut feel. And that is why there is higher volatility in the markets. Since this is medical crisis, first and foremost, we require medical solution. Either there could be combination of drugs which will protect people. And we are already seeing that between favipiravir class of drugs for the mild patients, remdesivir kind of drugs for the intermediate stage, and dexamethasone kind of steroids for the serious patients, doctors have been able to create a reasonable protocol which has brought fatality rates down. While second wave is coming up in Europe, the fatality rate is significantly lower. The second option for medical solution is vaccine. Today, world over, best minds in medicine making are working on discovering vaccine for COVID-19. Moderna, Pfizer, AstraZeneca, these are some of the companies which are working to find vaccine. There is hope that somewhere towards end of this year, beginning of next year, we will have an effective vaccine to contain this virus. Of course, it will take months for distribution, but with vaccine in hand, a lot of people will go back to normal life. A medical solution will ensure durable economic recovery and end to financial crisis. Today, market is pricing in that somewhere towards year end and beginning of next year, we will have durable vaccine in our hand. Second thing comes in terms of economy. In the first quarter, Indian economy degrew by 24%. It's one of the highest in the world. In a poor country like India, we had to give weightage to lives over livelihoods. We enforced strictest lockdown in the early stage. It hit us economically, but it ensured that lives were protected. Economic output missed can be recovered next year, next month, next week, but life gone cannot be retrieved. Now, slowly unlocking has begun, and there are sectors like power, telecom, FMCG, pharma, online distribution, where by and large industries are back to previous year level. There are sectors like tractors, automobiles, fertilizers, iron and steel, cement, where slowly things have started getting normalized and going back to previous year level. There are sectors like hotel, tourism, travel, aviation, multiplexes, retailing, where activity levels are far below previous year level. But if we summarize this entire thing, July was better than June, August was better than July, September was better than August, and October is likely to be better than September. We are seeing that in September, GST collection went up by 4% over previous year. Hopefully this trend will continue, and by March 2021, GDP will show positive growth. Now, most important thing is that, okay, how do we convert this into investment opportunity? How do we make money out of this? There are two ways of making money in equity market. Well, there are multiple ways, but I'm just talking for ordinary investors like you and me. One is to be a long-term investor. Buy quality stocks, stay invested over a long period of time, you will make money. The same can be done by buying direct stocks or by buying via mutual fund. If you see mutual funds NAV, they keep on going up and down every year. In 2008, our NAVs were down probably about 50%. But if you see from 2000 or 1990, our NAVs are up 100 times, 50 times, 25 times, 10 times. So if you remain invested for a longer period of time, you will have a roller coaster ride in between, but eventually you will exit at a far higher level than what you entered. In today's time, if you buy and stay invested for a long period of time, you will make money in equity mutual funds like you have made money in the past. Of course, the downside is that it will have high volatility. You will see a roller coaster ride. You will see sharp corrections in NAV as markets come down. The second option is to do what is known as asset allocation. When I started my career in investments world, I went to an elderly gentleman and I said, "Uncle, if you can tell me what is the way to make money in market?" And he said, "It's very simple. Buy low, sell high. Just remember this and you will do good." Now, it's such a simple advice. Buy low when things are cheap, sell when things are expensive, and you will go home with money. It was such a simple advice, but so difficult to execute. How do you know what is low? How do you know what is high? Over years, we worked on our model, and now in Kotak Balance Advantage Fund, we are trying to do what we have been telling others in terms of buying when things are cheap and selling when things are expensive. In many of our equity funds, we don't follow this model because we are long-term investors. We believe there will be ups and downs, but over a period of time, we will make money. In Kotak Balance Advantage Fund, we are trying to decrease our allocation to equity, looking at valuation of the market. This fund can invest 20 to 80% in equity. When we are putting 20 to 40% in equity, that means we believe markets have become expensive and one should be a seller in equity. When we put 40 to 60% in equity, we believe markets are fairly priced. One can be equal weight to equity. And when we put 60 to 80% in equity, we believe markets are cheap. One should become greedy. One should buy as much as possible. Now, last 6 months, we have seen 360-degree journey. On 17th of Jan at 12,352 Nifty, our Balance Advantage Fund equity allocation came down to 39%. With the benefit of hindsight, we should have kept it at 20%. Because models are not perfect. They can give you direction. They can give you exact points. On 27th of March, index was at 7,800. Our equity allocation became 75%. Now, ideally, with the benefit of hindsight, we should have pushed it to 80%. But 75 is as good as 80 over a longer term basis. Today, when markets are at about 11,700 Nifty, we are at 45% allocation to equity. Effectively, by following this disciplined model of buying when valuations are cheap, we have increased equity allocation. When valuations become expensive above historical average, we have reduced it. It's not perfect model. It doesn't just tell me sell at 12,352, buy at 7,800. No, it doesn't happen that way. But even by managing this kind of near perfect solution, we have done well. September 18, September 19, September 20, for 2 years, Nifty has hovered around 11,000. And in that 24-month period, this fund is up 18%. In a flat market, this fund has delivered 18% return to investors, apart from covering our expense ratio. This disciplined asset allocation of buying when equities are cheap, selling when equities are expensive can also help you make money. The next question then comes about regular investment. This is where it becomes extremely critical to have the discipline of regular investing. In the month of Jan 20, almost all our equity funds were delivering double-digit return across most periods and higher single-digit across few periods. This was dream come true for investors. In some of our equity funds, they were getting upwards of 15% compounded return for 10 years plus. March 20 became nightmare for investors. Our equity funds SIP returns turned negative for up to 5 years. The longer term SIP returns came down by half into higher single digits. Clearly between Jan and March, everything crashed. March, April, June was the time when social media was going gaga about SIPs, how they have not delivered return, how one should stop. People who continued their SIP listening to advisor like Mr. Choklingam, today they are reaping the reward. In September end, across most time periods, our SIP returns are in higher single digit to double digit. They are not as high as Jan 20, but certainly they are significantly better than March 20. It's not dream come true return for investors yet, but certainly it has delivered outperformance over many other instruments, including bank deposits and public provident fund, and so on and so forth. SIP returns in a bear market will always be negative or poor. SIP returns in bull market will be always positive and good, which is why doing this regular investment is critical. Ignore social media noise. Listen to your own advisor like Mr. Choklingam. Continue your SIP when returns are poor, because whatever SIP you did in that period, they will deliver maximum return. Today, at this point of time in equity, our view is that this is fair value market. Markets are pricing in future with lot of optimism. Hopefully with medical solution coming through, that will materialize. India has certain advantages. It has $550 billion reserve. Oil prices are down. Government has unleashed reforms in agriculture and labor sector. People are trying to move out of China, and some industries will come to India. RBI is betting like Rohit Sharma, hitting every ball for a 4 and a 6. That kind of monetary stimulus will ensure that recovery happens. Government is also taking corrective action on improving ease of doing business. Put all these things together, could we see a better GDP growth rates in FY22 or calendar year 2021? Answer is undoubtedly yes. In this optimist market, it makes sense to be equal weight to equity. Continue your SIP. Within equity, you should be marginally overweight small and mid-cap stocks because they have taken a high BT. They are still down 30% from their all-time high level. Within this time period, at this point of time, you could be marginally underweight large cap, but this is marginal position, not substantial position. If you are a conservative investor, large cap fund like Kotak blue chip will be more appropriate. If you are average investor, Kotak standard multi-cap kind of multi-cap fund will be more appropriate. And if you are aggressive investor, Kotak emerging equity kind of mid-cap fund will be more appropriate. If you want to do lump sum investment, then Kotak Balance Advantage fund will be more appropriate. But ideally, we will recommend you to invest via SIP or STP rather than lump sum, as markets are fairly priced. Coming to fixed income side, again, fixed income market has witnessed huge volatility. In the month of March, liquid fund delivered negative return for few days. People who were smart ignored that negative return and stayed invested. People who were listening to social media noise got panicked and greedy. and ended up losing return, as on 6th day, liquid fund went up and covered for previous 5 days losses as RBI intervened in the market. In the month of April, Franklin Templeton announced binding of 6 schemes. Again, social media went gaga over it. Even though Franklin Templeton's own equity and other debt schemes were operational, doubts were casted on the entire mutual fund industry. We all received unexpected redemptions in our credit fund in month of April. Entire mutual fund industry's credit risk funds witnessed redemptions in few days after Templeton announcement. Thanks to people like Mr. Chokalingam, we were able to reach out to investors and convince them that what happened with Templeton was an isolated incident that was not applicable to other mutual funds. Slowly panic got over. And in that time period, even though we had unexpected redemptions, we liquidated our portfolio and paid back money to investors. Of course, when redemptions surge and you have to sell in the market takes its pound of flesh. Every buyer knew that mutual funds were desperate sellers as they had to meet redemptions. We didn't want to compromise on the quality of portfolio. So we sold lower rated papers rather than higher rated papers. In the process, we were fair to the investors who were redeeming and also fair to the people who were staying back. In the month of April, our credit risk fund delivered about 3% negative return as there was desperate selling. In the month of May, June, July, August, September, in 5 months, our credit risk funds are up 6%. Not only it recovered all the loss of March, but it also delivered positive return with all-time high NAV. People who stayed back enjoyed for that patience. People who listened to the noise in social media and took decision paid the price. My recommendation is that when you are investing in credit risk fund, please be aware that there will be always credit event. In COVID-19 era, there will be delays, there will be defaults. But a delay or default does not mean that your capital is gone. A delay or a default pushes us to mark down the paper by 75% or 100%. But that doesn't mean that that money has disappeared. We will enforce security, we will work with the management and recover the money. As money is recovered, that will be added back into the net asset value. When you are investing in credit risk fund, take a 3-year view, be ready for 1 or 2 credit events. But overall, on a 3-year basis, I'm sure credit risk fund will deliver better return than alternatives. There could be some investors who will say, why should we take credit risk in fixed income? We want this money to be safe. Of course, if you want money to be safe, then you need to take interest rate risk. Without risk, there is no return. You can invest in short-term bond fund, banking and PSU debt fund, corporate bond fund, or dynamic bond fund, or government securities, where credit risk is minimum, and we try to generate return by investing on the maturities. When you invest in, let's say, 6% fixed deposits for 10 years, and when you invest in a government securities yielding 6% for 10 years, both of them move in same fashion when interest rate goes up and down. If tomorrow bank starts offering 7% for 10-year fixed deposit, the mark-to-market loss on your bank FD is as much as the GSEC getting mark-to-market at 7%. In bank deposits, loss is not accounted. In government securities, it is reflected into net asset value. My gilt fund, my bond fund will fluctuate. Your bank deposits will not fluctuate, even though impact is the same. So if you are comfortable taking that volatility which comes due to mark-to-market, then bond fund, gilt fund, dynamic fund will be appropriate for your investment. Debt fund SIP also is a good concept. It allows you to invest through the cycle of interest rate movements. And in today's environment, we think, well, interest rates are going to go down. it will be appropriate to invest in longer dated funds like dynamic bond fund, banking and PSU debt fund, corporate bond fund. The third fund in our portfolio is gold ETF, gold funds. Gold is an important asset class for investors. Generally, when interest rates are low and liquidity is high, gold prices do very well. Last time when there was a crisis in 2008, central bankers around the world printed currency and cut interest rates. Gold prices moved from $750 in November 2008 to $1,900 in September 2011. Now, same scenario prevails. Interest rates are low, liquidity is high, and gold prices have already moved from $1,450 to $1,900. You can invest in gold by buying into physical gold, by buying into gold ETF, or by buying sovereign gold bonds. Sovereign gold bonds are the best because they give you 2.5% interest income when you hold it for 5 or 7 years. Physical gold is probably the worst, as buying small quantity of physical gold, you have to pay 20-30% premium. If you buy 5 gram, 1 gram, 10 gram gold coin from bank and sell it to the jeweler, you will straightway lose 15 to 30%. That's the premium you have to pay for buying gold in smaller quantity. Gold ETF that way is better than physical gold, no risk of losing due to theft, and more importantly, entry premium is hardly 0.5% to 1%. We recommend one to consider gold ETF as part of their portfolio. Only one caveat while investing in gold ETF. Today in India, gold has import duty of 12.5%. What is worth $100 of gold in Dubai gets valued at $112.50 in India. If tomorrow Government of India decides to lower import duty on gold, gold prices will correct by 12.5% in single day in rupee terms. Subject to this caveat of gold import duty, which can influence gold prices, one should consider investing in gold ETF. This is undoubtedly one of the most unprecedented times, but disciplined investors will make money in this market. Ignoring social media noise is extremely critical. For any event, they have to create noise, and it is our job to differentiate between what is noise and what is news. 4 years ago, when Donald Trump became US president, unexpectedly defeating Hillary Clinton, markets corrected. But that was a very short-term event. Similarly, when Brexit happened in United Kingdom and unexpectedly UK decided to move out of EU, markets corrected. But that was a temporary event. It didn't change or alter India's fundamental. These transient events create an opportunity for you to invest if you can distinguish between noise and news. My recommendation is ignore noise, be disciplined, and that will do wonders for your portfolio. Happy to take your questions.
Thank you, Mr. Nilesh, for your wonderful speech. A few questions have come in. Before that, just I wanted to get some clarity on some of the current events that you touched upon. So, like, how much effect this this forthcoming election in the next 1 or 2 months in US will have on the Indian economy and the of course the stock market? Indirectly it is related. So, what will be the impact for the US election on Indian markets and Indian equity mutual funds, and how investors should use this opportunity?
So, in politics, there are no permanent friends or enemies. It's all permanent interest. Now, whether Biden becomes president or Trump, US will need India. US is fighting a war with China, where they are #1 economy in the world and coming down, and China is #2 economy and going up. In order to contain China, US needs India, no matter who the president might be. So from our economic interest point of view, will American companies continue to invest in India? Answer is yes. Will American president continue to support India? Answer is yes. The degree may vary a little bit, but direction is not going to change. If President Biden wins, there is fear that there will be immediate correction in US market. This is based on what commentators in US markets are talking about. If President Trump wins, markets may not correct and they may continue the momentum. Now, my opinion is that in case Indian markets correct in sympathy with US market, if there is unexpected victory of President Biden, then that will be a great opportunity to invest into our market. For a long-term investor, US election is a noise. For an investor who wants to invest in market, that correction will be an opportunity to invest.
Good. Thank you. And along the similar lines, the Chinese, companies moving out of China, and I think in the recently also Foxconn came to Chennai, invested about 6,000 crores for mobile handset and all those things. So, and we hear that chemical industries are moving out of China, coming to India. So how much this of moving out of China, coming to India, along with corporate rate tax reduction in India, which happened last year, how much this will benefit the economy, Indian economy, because if economy goes up, our market goes up, mutual funds go up, investors are happy. So last 10 years has not been that great, probably 8, 9, 10% returns, index, mutual funds, everything, equity funds. So in the next 10 years, in the next 5 years and 10 years, how will be the Indian economy? Because are you seeing any fundamental changes happening in India?
So if we look at 1980, India and China were of similar size. Then China started attracting foreign direct investments. They invited companies to set up their manufacturing plant in China. They built infrastructure at a rapid pace. There was no democracy to delay projects like we consistently do it in India. Chinese laborers were working like a sweatshop. And in no time, China became second largest economy in the world. China adopted many fair and foul means, including taking away technology by snooping, doing underhand dealings. And all those things resulted into China becoming manufacturer to the world, $3 trillion FX reserves, $3 trillion of exports, $14 trillion of GDP. Somewhere India was left behind. Now, companies wants to move out of China. They are suspicious of China. They think China gave them Wuhan virus, whereas India provided hydroxychloroquine tablets. No matter which country discovers vaccine, they'll have to come to India for mass manufacturing, as 60% of vaccines are manufactured in India. Person who saves will always get more value than person who kills. There is a tremendous goodwill about India today, and companies would like to come to India. It is up to us how much we can absorb. Now, as Indians, we have our limitation. Our infrastructure is poor. Our approval process is poor. But we have two models in front of us. One is what is known as Singur model. Tatas are the most respected business house of India. They have been running Jamshedpur like an exemplary city. Wherever they have gone, they have uplifted socially people around their factories. Despite that legacy, when they went to Singur to set up their automobile plant, for years they could not settle it. People kept on protesting. Finally, Tata's got tired and moved with entire machinery and plant. They were sent a SMS called Suswagatam by then Chief Minister of Gujarat, and Tata's entered into Sanand. In 18 months, their factory started rolling out motor car. If we adopt Sanan model for all those companies moving out of China to India, India's growth orbit will change. If we adopt Singur model, then India can never progress. It is up to the citizens, government, both central and state, and policymakers to ensure that India lays a red carpet to capture this once in a lifetime opportunity. We missed it in 1980. For 40 years, we have been left behind by China. They have become 5 times bigger than us. Now let's work hard for next 20, 30 years and ensure that we lay a red carpet for capturing companies coming out of China to India and change India's growth orbit and at least start narrowing the gap vis-a-vis China. If we are going to do Sanan model, I have no doubt that Indian economy and Indian stock market and mutual funds will do very well. However, if we do Singur model, then there is no hope for us.
Okay. Thank you very much. That was a clear-cut answer. And now Mr. Manigan Palnivel from Singapore, he has a question. Irrespective, he is our investor also. Irrespective of all the corrective measures by our government, RBI and attracting foreign investments, etc., still our country's GDP is not having much significant positive impact. Please enlighten us on this.
So today when we look at our GDP, it's roughly about 2.7, 2.8 trillion dollar. It's there in top 10 economies in the world. But looking at our population, we are somewhere in the bottom quartile in terms of per capita GDP. Bangladesh will have higher per capita GDP than us next year. It shows importance of growth. Now there are multiple reasons why we are here. One, we lost talent like Mr. Manian, who had to migrate offshore for better prospects. Our IITs, IIMs, they have today gone and become Fortune 500 company CEOs. And in those days, India didn't provide them opportunity. Now, can we leverage this talent and request them to set up their companies in India? They'll be more than happy to serve Mother India, provided they get Singur Sanan model and not Singur model. The second thing is related to few of the things which we have been not doing correctly. For example, as Indians, we were indifferent to made in India goods. Our trade deficit with China was peaked at $60 billion. Now, there are certain items which we had to import from China, like APIs for bulk drugs. But we were importing even Amba Mata Murti in Navratri season from China. The electric lights on top of temple was Chinese. Now, was it necessary to import Amba Mata Murti from China? We could have always encouraged local production. It would have costed us more, no doubt about it, but we could have afforded that. Now, we have started reducing trade deficit with China. From $60 billion, it became $48 billion last year. And this year it is likely to be probably about $30 billion or $35 billion. The day Indians become proud of India-made products and says, I won't buy Chinese products, automatically growth starts happening in India. So there are multiple reasons why India has not done well. It hasn't achieved the potential which it has with the kind of talent, with the kind of commitment we have. But hopefully, slowly and steadily, things are improving. Unlike China, where decision making is very, very quick and there is no scope for protest, in India, we are like an elephant which has to move slowly because we have to build consensus and move forward. Now, let me give you very small examples. Netherlands' size is less than probably half of Tamil Nadu. It exports $80 billion of agriculture goods, including vegetables and flowers. And half of Netherlands has the land which is below sea level, and that's why you see those windmills throwing water out consistently. India has world's largest arable land, and yet our agriculture exports is $20-25 billion. We created policies which restricted our farmers rather than supported our farmers in the name of protecting farmers. For 70 years, we kept on chaining our farmers rather than liberating them. Now we have come out with agriculture reforms. If we can follow it through, I'm sure India will surpass Netherlands in terms of agriculture exports. In 1980, we could have been open to the world and people would have come to set up their offices, factories in India. We were sleeping at that point of time. In 2020, we have a chance to bridge that gap. It's not going to be an easy road, but we are working on it. Many years ago, Nokia came to set up their largest mobile handset factory near Sri Perambur in Tamil Nadu. Unfortunately, it got shut down for a variety of reasons. Now, today, we have come out with ELI scheme to ensure that mobile handset makers set up their factories in India. Now, if we don't repeat the mistake of shutting down Nokia's mobile handset, hopefully India will become exporter of mobile handsets from being importer of mobile handsets. So there are multiple steps taken by the government, but as I say, this is economic development is like a teamwork. Only if coach keeps on deciding, it doesn't work. Players also have to play a role. And only batsman doesn't have to score run, fielder have to stop run, wicket keeper has to collect ball, and bowler has to bowl economically. When all players work together, it is symphony, otherwise it is noise. In the last 70 years, we have created more noise and less symphony. Let's hope that over next 20-30 years, we create more symphony and less noise.
Thank you. It was an elaborate answer for his question. Great. And now another Vignesh has asked a question that he has checked the Nifty mid cap 150, small cap 250, and even Nifty next 50. They all have not moved up compared to the point it was 3 years before. I have not checked the fact.
Yes,
but
he's right.
What is the reason for this? Does economic policies like GST or demonetization have impact in these mid-cap or small-cap indices? Because the time frame more or less matches. If yes, what will be the future of mid-cap and small-cap?
So small and mid-caps have witnessed drop from 2017 level. And the real reason behind that is that between 2016 to 2017, they went up like a rocket. If I remember correctly, calendar year 2017, small cap index delivered 50% return. Now, normally you make that kind of return in 4 years, not in 1 year. If you went up like rocket, you have to come down also crazily. And which is why over 2018, 19 and 20, indexes haven't moved much because they had gone up too much in the beginning phase. Demonetization and GST are excuses. Many people say demonetization is failure of government. Well, government was trying to take out black money. It gave a chance to citizens to come clean and pay taxes. Citizens were like dog's tail. They didn't change. They found out ways to retain their black money. Now, is it failure of citizen who didn't come out clean? Or is it failure of government who wanted citizens to come clean? In GST, again, the same thing happened. So many honest businesses are happy that GST is there, and now avoiding taxes has become more difficult. There is an association in Rajkot which has now said that if any of its member is found avoiding paying GST, they will debar him. If that kind of movement happens where citizens starts paying their share of tax honestly, automatically India's tax to GDP go up. We are the only country in the world where more number of people are buying expensive cars than declaring equivalent income. No matter how rich you are, will you spend 1 year of your income in buying a car? It's impossible. If I'm earning 100 rupee, I'll probably put 5 rupee in buying a car. If I'm flamboyant, I'll put 10% of my money in buying a car. I will never put 100% of my income in buying a car. And yet in India, time and again, people who are buying luxurious cars are not declaring income equivalent. That shows that as a nation, we are not good taxpayers. Many people still believe that India is ruled by Britishers, and if they pay tax, it will go to the Queen of England rather than President of India. Now, unless until we can make this ignorant people knowledgeable, this problem will continue. So small and mid caps have not crossed 2017 peak, because 2017 they have gone up too sharply. The 50% return in 2017 was actually return for 18, 19, 20 also. And that is where we say that this is the time to be marginally overweight small and mid cap. From 2019 to 2020, they are up about 14 to 15%. And now we think there is same opportunity for small and mid caps to deliver return over large cap.
Very good. Very good. So he has to wait some more years, and it comes in bounties, as you are saying, once in three, because it is a capital asset, so it has to. And one of Mr. Subramanian Muthukumar, his question is, what is the reasonable timeline to review the performance returns of our mutual fund portfolio through SIP? Is it wise to switch over from one SIP to another, say, after investing for 2 to 3 years?
See, there is no one right answer for this. If you have Sachin Tendulkar in your team and he scores 4 ducks in a row, will you throw him out? No. Form is temporary, class is permanent. At the same time, if you have Sachin Tendulkar who is aging 40 years, then will you back him, or will you say that now it is time for you to retire? So when you're looking at your SIP returns, you must not look at SIP returns in bear market, because it will always be poor or negative. And you must look at SIP returns in a bull market, where returns will always be positive and good. So ideally your SIP should run from bear market to bull market. And since we don't know bear market to bull market always, it's far better to be a long-term investor in SIP, because there will be a couple of bear market, couple of bull market, and over a period of time, you will see your SIP returns coming through. In a simple word, enter SIP in a bear market, exit SIP in a bull market. Now comes within SIP portfolio of 5-6 schemes. Should I put money only in good performing schemes? Should I move out of bad performing schemes? Well, that call has to be taken keeping in mind the portfolio of schemes. If portfolio is good and returns are bad, don't exit. But if portfolio is bad and returns are bad, please exit. So you have to go by form, class rather than form. Each scheme will have their ups and downs. But if their longer term track record is fine, then you must continue with some underperformance in the short term. Over a period of time, class will prevail over the form.
Okay. Thank you, Nilesh. And another investor, Anand, I think he is interested in knowing if any market crash is expected in the coming days.
Anand, it's always difficult to predict market. But let me tell you, events, if that happens, which is not discounted by the market today, then market crash can certainly come. So today market has not discounted any war with China. It believes winter is coming in November. In those cold terrain, in winter, no one is going to go to war. What if there is a war with China? Markets will crash undoubtedly. Today market has not discounted withdrawal of monetary stimulus by RBI. Market is actually confident that RBI will not withdraw monetary stimulus for a long period of time. But against all odds, what if RBI raises interest rates tomorrow? then obviously markets will correct because market is not pricing that event. Market today is pricing in that medical situation will come under control, fatality rates will be down, standard protocol of medicine is emerging for treatment, vaccine is on its way. Now, what if none of that materializes and medical situation goes out of control and we have to impose lockdown? Markets will correct because market is not pricing this thing. What if there is a big spike in oil and it goes to $100? Undoubtedly, markets will correct because market is pricing in $30, $40 of oil, not $100 of oil. So any event which market is not priced in, which market is not discounted, which is unknown to the market, if it happens, there will be correction in market.
Thank you, Nilesh. And one of the Joe Naveen, he has asked if Kotak Mutual Fund has S&P 500 fund.
No, unfortunately, we don't have. We were late in reckoning need for offshore investment. We have filed our prospectus for NASDAQ 100, and this is essentially driven by the fact that when I try to replicate S&P 500, for every script which I buy, I have to pay $20 by way of brokerage as minimum brokerage. Now, on 500 stocks, $20, it's $10,000 for every transaction. That's a fairly high cost. On 100, at least I will be able to do it at $2,000 per transaction. So we are looking to launch NASDAQ 100 index rather than S&P 500.
Okay. And the same person has asked your views on investing in S&P 500, I mean international fund for that matter.
Definitely one should invest in offshore funds. I don't have many offshore funds in my portfolio right now, but that should not stop me from telling the truth. One must have allocation to offshore funds. They are essentially your gateway to businesses which are not in India. There's no equivalent of Amazon, there's no equivalent of Google, there's no equivalent of Facebook, there's no equivalent of Netflix in India. Even if we have business models around them, they are inferior models. And hence, it does make sense for an investor to put 10-15% of his wealth in offshore funds.
Okay, good. So it's kind of an allocation you are giving, 10 to 15, not exceeding 10 to 15%. It is advisable. Mr. Chandrasekharan has a very pertinent question, which is related to our markets and newspapers every day. In spite of increased strict norms implemented by Finance Ministry and RBI, still hidden NPA are coming out. This affects the equity markets as well as mutual fund market. I am seeing the mutual funds are not growing more than 10% growth over year on year. How do you feel on it? Especially you can take it as an NPA question on banks and this moratorium given and bank NPA is increasing, and little bit if you can elaborate, because our banking stocks have like 30-35% weightage on the index, if I am right. So they are the front runner of the economy. So how this will affect and in turn the mutual funds? So
if we look at mutual funds, since September 18, we have witnessed numerous credit events: ILFS, Diwan Housing Finance, Yes Bank, Cox and Kings, Syntax Industries Limited, ADHE Groups. All these events have resulted into hits on various funds. On the other hand, there are some events where we could see full recovery of money. In our case, in April 19, we had to withhold money in 6 FMPs, which we had invested in SL Group companies. In 6 months, we were able to recover money and pay back. Vodafone Idea, same thing happened. Investors were able to recover money and pay back. So one, as I mentioned earlier, NPA does not necessarily mean loss of capital. There is mark-to-market loss when a company becomes NPA in mutual fund as per regulation. We have to mark it down by 75% if it's a secured debenture and 100% if it's an unsecured debenture. But that doesn't mean that I will lose 100% of capital. If you stay invested over a 3-year period and ignore such events, you will see a reasonable recovery. Now, coming to the economy as NPA, our real challenge is rule of law. We have seen so many promoters whose companies are bankrupt, but they are in too much of wealth. Very recently, a bankrupt company's promoter hosted a wedding ceremony for his daughter's wedding and spent 400 crore. Now, unless until we have a rule of law where when companies go bankrupt, the promoters also go bankrupt, how will we resolve NPA issue? The government came out with insolvency law. It had a time-bound commitment, but finally, in the process of judiciary, this whole timeline got extended. It is extremely important that we manage NPA crisis like we handle Satyam rather than like we handle security scam. If you see 1991 security scam of Arshad Mehta, till today cases are going on. Everything is stalled. Convicts are dying before they can be punished. Net, the rule of law is not visible, and justice delayed is justice denied reflected there. On the other hand, when Satyam Computers problem happened, there was out-of-box thinking. Deepak Parekh led a team of experts to rehabilitate Satyam. They sold Satyam to Mahindras. All employees' jobs were saved. India's reputation as IT industry was saved. There were not much borrowing in Satyam, but government continued to collect taxes from them. And net, Satyam, instead of becoming non-performing asset or a disaster for Indian IT industry, survived and prospered. If we can resolve NPA issues like Satyam through out-of-box thinking and ensuring that promoters who have siphoned off money from their companies pay a huge price for the same, there will be manageable NPA problems in India. Today, when you go to Emirati Hills, you find virtually who's who of the defaulter of Indian banking industry having bungalows there. We can't allow a system where defaulters take money out of their company, money out of our country and park it overseas. The rule of law must prevail for solving NPS in a timely manner like we did it with Satyam. If rule of law prevails on NPA side, we will be in a far better position. If we continue to manage NPA problems like 91 security scam, then there is no hope for us. I hope and pray that we are slowly and steadily moving towards quicker resolution of NPS through insolvency laws.
Thank you, Nilesh. It's about 12:02. We will take a few more questions. A lot of questions are arriving, but anyway, and you have also some other things to take care. So one of the questions, 2-3 questions I am combining. A few people have asked about which sectors will perform better going forward, and if they can take position in pharma funds.
I might be proven wrong on this. Or actually, I will be proven wrong on this because in a market, few sectors will always do well. But at this point of time, my recommendation will be for diversified fund rather than sectoral fund. Today, there's so much of uncertainty. Pharma is doing well because they have unrestricted access to their factories. Government encourages them to run their factories. Tomorrow, when medical solution arrives, other factories also will run unrestricted. Now, that can change dynamics of pharma companies and pharma sector. So, my recommendation today will be to go for a diversified fund or at best a thematic fund. Let there be finance, technology and pharma fund together, which becomes a thematic fund rather than just one sectoral fund. That will undoubtedly reduce your return, but it also will reduce your risk. In terms of which sector will do well going forward, again, it's function of how economy evolves. If medical situation improves, then non-defensives will do well. If medical situation deteriorates, then defensives like IT, pharma, FMCG will do well. At the end of the day, it is the company which matters and not just the sector. In a financial sector, one can create HDFC Bank or Kotak Bank, or one can create Yes Bank. Sector is the same. It's the promoter who makes the difference. So buy quality companies, buy companies with good governance models, stay invested for long term, you will make money. And keep diversified portfolio rather than concentrated portfolio. That diversification will no doubt bring your return down, but it will also reduce your risk and it will give you ability to hold those investments.
Good. Thank you. Thank you. And one more, probably pointed question you may choose to answer or not to. Market is high. Is this the best time to invest a large amount like 50 lakhs or 1 crore in mutual fund through STP? Please answer.
So you can't invest looking at market. You have to invest looking at your objective. Now let's assume you are a 70-year-old person who wants regular income. Then this 50 lakh 1 crore cannot come into equity fund. Bulk of it has to go into fixed income funds, and some part can come into hybrid funds like monthly income plan, which is now known as conservative hybrid debt fund, or it can come into equity savings schemes. Now let's assume you are a 70-year-old person who wants to put this money for their inheritance, for their grandkids. Then certainly you can afford to take risk on equity. But let's assume that this 50 lakhs is your entire corpus you want to keep for your grandkids. Now there's no point in putting 100% into equity. As I mentioned, this is equal weight equity, not overweight equity. So you will probably put 50-60% in equity now, and 40 or 50% you will put it into fixed income. If market gives correction, you will shift balance 40-50% into equity, but not at this point of time. Now, again, the choice is, should I go lump sum? If you go lump sum, then you have to invest in Kotak Balance Advantage kind of fund, which does the allocation. If you want to do systematic transfer plan, then you can look at Kotak Emerging Equity, Kotak Standard Multi-Cap, Kotak Blue Chip kind of fund. And STP will be over 3 to 6 months. If there is correction, you will prepone your STP. If not, you will continue your STP. So don't look at the market, look at time horizon, look at investment objective, and look at your asset allocation. This will ensure that you will be able to benefit out of this market.
Good, good. Thank you. That was a crisp answer. One more question. Nowadays, there is active versus passive. That is one thing. Direct versus regular. That is another thing. That is in lot of people's mind, and saying that, if I invest for the next 20 years through direct route, I may gain 25 lakhs or 30 lakhs extra. That whatever calculation papers are putting up, that is one. The other is active versus passive. So should I invest in active right now or passive right now? Just, your thoughts in general.
Sure. So between direct and regular, my recommendation is that please look at your knowledge about the market. If you are willing to come direct, you must understand that you have to do analysis of funds, portfolios, manage the accounting part, get the data for filing an income tax return. And all these things will require your time and commitment. If you are going to invest blindly, looking at some website giving past performance rating, that's not going to work. Remember, most schemes of Franklin Templeton were 5-star rated before they just shut down. Websites look at return, not at the risk. Your advisor will caution you about risk and return together. So if you don't have time, energy, knowledge, don't choose direct path. It's far better to come by advisor. When you fall ill, you don't go to chemist for medicine, even though he has 5,000 medicines behind him. You go to a doctor, get prescription, and then take it to chemist. Don't underestimate the role of the doctor. Second thing, between active and passive, today in India, there are lots of social media noise which says active funds are underperforming indexes. Now, do you know the reason why active funds are underperforming indices? One, in active fund, I am kept at 10% on a stock. Reliance Industries Limited contributed 60% in moving Nifty from 7,500 to 11,000. In the process, it became 15% of Nifty. But I can't put more than 10% in Reliance. Obviously, my funds will underperform. Number two, today my funds pay roughly about 45 basis points by way of GST and STT. In no parts of the world, indices pay GST and STT. Is it fair to put that burden of GST and STT on me vis-a-vis index? Third, today in index, when a stock goes out or stock comes in, it happens at closing price. But in portfolio, you have to have an impact cost. Fourth, index does not have any cash for giving you daily liquidity. Fund carries cash to meet daily liquidity. Cash underperforms equity over longer term. Put all these constraints in place and you will realize that fund managers on active side are still outperforming passive index. In fact, in India, because of this restrictions, even index funds are underperforming benchmark indices by a percentage point. So my recommendation is that keep faith in your fund manager. I have a selfish interest in that, but look at the data with little bit of sympathy for fund managers who are constrained by 10% stock cap, who are constrained by keeping cash for liquidity and redemptions, who are constrained by GST on their expenses, and who are constrained by impact cost on their portfolio, whereas index does not take into account. If you put that, you will realize that active funds are still outperforming index funds and active funds are still outperforming benchmark indices.
Okay, thank you. Similar to the earlier question, some of our investors are asking, do you have healthcare pharma fund? And or do you have plans to launch one?
I have pharma PMS. It has delivered 60% plus return last 1 year. And we are returning money over there as we believe the scheme has done extremely well. I don't intend to launch a pharma fund. I may launch pharma ETF as a part of my ETF buckets. But as of today, we have no intention to launch pharma fund. And the reason I mentioned that it is time to be focused on diversified fund rather than sectoral fund. What we are pushing together on PMS side is fintech fund, which is combination of financial services and technology, as we believe fintech has more chance of outperforming other indices, including pharma, over a period of time.
Very good, very good. So, and also along those lines with that, I think probably we will cap the questions. And now it's another 2 minutes there. So one of the earlier question was like on the digital funds, technology or digital, whatever you call. Probably in India, do you have one? And there are certain funds called digital funds. How they will perform? Again, it's a sectoral fund kind of thing. So what is your thoughts on that?
So unfortunately, today in listed equity market where we operate, there are very few digital companies. There is one Info Edge, and there may be a couple here or there. There's not sufficient universe for us to launch digital fund. We have launched technology fund as mutual fund industry. I per se does not have technology fund, as we are more believer in diversified funds rather than sectoral funds. But in industry, you will find many many technology funds. If you want to play in digital space, you will have to go to private equity venture capital route. It's high risk, high return. But if you invest with good quality fund manager in venture capital, private equity space, that will be a better bet on digital India.
Good. Thank you very much, Nilesh. There are a lot more questions we can run for hours, but keeping time in
There is
mind,
a
and
time
we told,
constraint.
yeah, exactly. 1 hour 15 minutes. We told we are spot on it, and right now we are completing 12:15 it is. So, thank you for accepting our invitation and answering so patiently and in a very simple and elegant manner. I am sure that all of our subscribers, YouTube subscribers, viewers, everyone would have benefited out of this conversation, and they might have got a lot more clarity. Probably we will upload once we receive the video in our YouTube channel where we have more than 22,000 subscribers. So we will upload that, and with that I thank you again once again, and all the participants for patiently listening and making their raising their questions, and hope we were not able to answer all questions. Probably you may email it to us wherever feasible. We will answer it through other channels or other fund managers from Nilesh team. We will have more, like, I think probably I intend to do one with your equity head as well, Nilesh.
Yes.
He's a fantastic fund manager, and many of your funds have done well, outperformed many schemes. And in the industry, it could be mid cap, it could be small cap, multi cap. Some of your funds are having like more than 10,000 crore assets. It's really gigantic to see those assets, and I'm very happy. And I wish Kotak Mutual Fund a great future, and our association with you also will keep growing. And for our investors, we together, let us make our investors wealthy and happier and healthier.
Definitely.
Thank you very much.
Thank you.
Thank you everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.